Hi everyone, Milad Rezai here from Anchor Wealth. I am going to talk to you guys about a very interesting topic today. The topic is tax, but franking credits to narrow it down and how it impacts your super fund. I'll give you a bit of an idea of what franking credits are. They have a few names. They could be imputation credits, but keeping it simple, tax offsets. And the idea there is that franking credits are tax that the company has already paid on its profits. What do companies do when they generate profits? They do one or two things. They usually keep some of the profits, maybe 50% of the profits. And if the company's been around for a while, they tend to reward investors for investing in their business by giving a part of those profits to the investors in the way of dividends, which is another name for the income that the investor receives. So companies share their profits back with investors, and taxation comes into play. So as the first part of the story is that the company pays the company tax rate on those profits at in Australia 30%. And then once those profits are then distributed to the investors, those investors, depending on where they are investing and what vehicle they've used, so if it's a super fund, if the members' super has invested in those companies, they are then taxed at the super tax level, which is 15%. And if it's outside of super, just as an example, again, we are talking about super today, but just as an example, those investors will get taxed at their marginal tax rate. So what is happening and why franking credits came to play? What was happening is that the investor was getting taxed twice. Once at the company level, indirectly, that 30%, again, because the company is using investor money to generate those profits partially. And then once those profits again are getting distributed to the investors, then they're paying tax again. So the second point of taxation is where the income comes into play, the dividends. So the Keating government back in the 80s thought, all right, we've got to stop these double taxations from happening because it's not a really fair thing to happen. And they introduced a franking imputation system to stop this. And that's why certain shares in Australia, certain Australian companies come with franking credits. They may be fully franked, and that means that the companies paid the tax on all of those profits. So those companies come with a fully franked dividend, and you can claim the complete amount. There are some companies that come with a partially franked credit. They're called partially franked shares, and that means the company has not paid tax on all of those profits. They may have paid tax on 50% of those profits. Now, this is a very powerful thing to consider when it comes to your super fund. It's considering and understanding how is your super structure treating these tax offsets. Because straight off the bat, if you think the super tax in Australia is 15%, and a fully franked credit fully franked share in Australia is 30% in terms of a tax offset. So it's already doubling up on what your tax is. So you're already in a positive space. And if these tax offsets are not hitting your super fund, or there is some roadblocks, middleman, if there is a lack of transparency inside your super when it comes to your tax offsets, you need to dig deeper. And from doing this for 10 years, now in 2022, my findings has been that most Australians sit inside a master trust superstructure. Now, what does this mean? What's a master trust structure? What about industry, retail, that conversation? All that is a layer above. What we're trying to do is dig deep. We want to understand the structure, and the structure of your super for most Australians is master trust, irregardless of if you're in a retail or a industry super fund. And the way a master trust superstructure treats its the process of receiving income and dividends and so forth, everything is bundled into what we refer to as units. And units are basically what you own inside your super. So if you have 10 units at $100, you got $1,000 in terms of super. So these, the income and the tax offsets, the franking credits, can't actually be unbundled from the units, and this can cause major potential issues in the sense of entitlement issues, in terms of transparency, and worse, dilution, not receiving what you're entitled to. And the problem with it is that you can't actually get cemented figures in terms of what you're entitled to and whether you received what you should have, because like I said, it's a bundled structure, and most super funds have a bundled structure. Again, what you see with most Australians, they jump ship and go from one super fund to another one, looking just at the name at the top. But end of the day, they are still in a master trust structure. So the change is very minuscule in terms of benefits. They might save a few $100 in terms of fees, and the investment options might be one or two more. But at the end of the day, the biggest change is the structure of the fund. So this is what you need to consider. Now, what's some alternative super funds and how do they operate? Well, there are alternative super funds in Australia where the income and the tax offsets are unbundled. It's an unbundled structure. And the way it works is that you can see exactly what's happening with these tax franking credits. You can see what's happening with the income side of your investments. It's all unbundled from the units, giving you the transparency. So this is what's available to Australians in terms of an alternative super structure. And if you want to find out a bit more about this, there is a link at the bottom. You can lock in your free 30-minute video strategy session, and we'll talk to you about your super structure. We'll talk to you about your super position and where it's all heading. And it'll allow you to make an informed decision.